Well, good evening, class.
You are welcome to the
Good
second class.
evening.
Yes, good evening. So you're welcome to our second class on corporate reporting. We held our first class on Wednesday, I guess. So today we'll continue from where we stopped. My other colleague could not be available tonight. That's why I'm taking this class. So from next week, he will be taking Friday's class while I will be taking classes for Wednesday. But we need to move on without wasting so much time. Um, Welcome to Equity Professionals once again. And this is corporate reporting. And this is Wasil speaking. Last week, we started with regulatory framework. And in there, we established that reporting generally is governed by regulations, and these regulations are rules and principles that govern reporting generally. And these rules and principles, we call them GAP, Generally Accepted Accounting Principles. And this GAP, we said there are three: the National Accounting Standard, the National Company Law, and the Local Stock Exchange Listing Requirements, which we'll explain in-depthly. But we narrow down to accounting standard since this course is about corporate reporting. So our focus is going to be on the accounting standards. So we moved on to trying to draw a separation between rules and principles, that this gap, saying they are the rules and principles doesn't mean rules and principles are the same. So we mentioned that principles provide the foundation for chain of reasoning. It allows professional judgment, and it's just provide a general guide on which the professional accountant can then make certain judgments in preparing or applying those general guide. So an example of these principles is the IFRS. IFRS is principle-based reporting framework. However, the company law and the local stock exchange listing requirements, these are rule-based reporting framework, and that gives strict or specific guide, not guides, specific rules or steps on how to carry out an activity. So, I'm sorry, just give me a few seconds. Okay, so sorry. I had to attend to something urgently. As I was saying, so the company law and the local stock exchange list requirements, those are rule-based reporting framework. However, in some other countries, their own accounting standard are also rule-based. But in Nigeria, ours, which is the IFRS or the IAS, is principle-based. So we can say that in Nigeria, our regulatory framework is a mixture of rules and principle, rule-based and principle-based. Then we moved on to the regulatory bodies because that settles the regulation entirely. Then we moved on to the regulatory bodies. And the regulatory body in charge of IFRS in Nigeria is the Financial Reporting Council of Nigeria. And this body, we said, was established in 2011, and it is headed by Dr. Abi Olowo, and they have been trying a lot to ensure high quality of financial reporting services are given in Nigeria. When they were established, one of their key and core objectives is to protect the interest of investors and other stakeholders, and some other objectives too, like ensuring that companies have good corporate governance practices, providing guidance on issues relating to financial reporting and corporate governance, and also providing guidance on issues on corporate governance, ensuring accuracy and reliability of financial reporting, ensuring high quality of services among auditors and other professionals, harmonizing the activities of professional bodies, and all of that. So, and that's the Financial Reporting Council of Nigeria. However, I mentioned that the Financial Reporting Council of Nigeria does not actually develop IFRS. What they did in 2011 was to adopt it, right? They adopted IFRS in 2011. So the international body um, that is in charge of IFRS, that actually develop IFRS, we called it the IFRS Foundation three-tier structure. And this IFRS Foundation three-tier structure means that there are key standard setting board of experts, which are the IASB and the ISSB. The IASB is in charge of developing IFRS. They have been bestowed with that responsibility, while the ISSB is focused on developing IFRS sustainability disclosure standards, which we're going to look at later on. However, you see, this standard setting board are actually supervised by an IFRS foundation, or the trustees of the IFRS Foundation. They are the one that delegated those responsibilities to this board, because this foundation are the ones that carry the mission themselves. In fact, they are the one that has the mission of developing accounting standard. And this foundation, I told you, they have four objectives, which they have achieved so well. One is to develop a single high-quality global accounting standard in public interest. Two is to promote the use and rigorous application of this standard. And three is to meet the needs of SMEs and emerging economies. And four is to harmonize local and international standards. And this IFRS Foundation are also supervised by a monitoring board. The monitoring board who appoints them, the monitoring board who can even fire them. And again, this monitoring board is there to ensure that this structure is practical. This structure, whatever it is they are doing, in these people responsible for developing IFRS, whatever they are doing in that structure reflects what the market needs. So the monitoring board, to achieve that, their members majorly capital market authorities. They are the one that actually mans the monitoring board. Now, this monitoring board therefore provides like a formal link between the trustees, which is the structure, and the capital markets and the markets, just to ensure that they are doing what they should do. Now, that's the board in charge of IFRS. Then we looked at the process involved in developing IFRS. We looked at 4 steps, from agenda consultation to research program to standard setting program to maintenance program. Then we moved on from there to why regulation is necessary, which is the need for regulation. We explained that to you as well. Then we rounded the class up on that note. And that class took us well over 2 hours, or even 2.5 hours. I think 2 hours that we spent in that class. And it was worth our while. And okay, so that's a summary of what we did in the last class. And by now, I expect every one of you should be able to do the same summary. I expect that you should have read that note, because the journey has started already. This is our second class and we are moving very fast. Now, today, we are going to another very important topic, which is conceptual framework. So what is a conceptual framework? From what I have here, he said a conceptual framework is a statement of generally accepted theoretical principle. This is similar to saying that conceptual framework is gap. Yes, it's not wrong to say that the conceptual framework is gap. The only thing here is this. The conceptual framework is now a little bit above gap. Why? Because the conceptual framework forms the frame of reference for financial reporting. When we say something forms the frame of reference for financial reporting, it means that that is what you ultimately refer to. It means that that is the source. So those gap we mentioned, particularly the accounting standard, the source of that accounting standard is the conceptual framework, which means that the conceptual framework is what provides the basis for the development of new accounting standard and the evaluation or amendment of those already in existence. So the conceptual framework we are looking at today is what they use in developing standards, is what provides the basis. So when the IASB wants to develop accounting standard or IFRS, what gives them the guide is the conceptual framework. So conceptual framework is just like a forest. I mean, when you're talking about the furniture you are sitting on right now, let's assume that you're sitting on a chair and a table, right? A finished chair and a table. So the way the forest or the trees is to those chair and table that you are sitting on, right? That's where they will have gotten the materials from to make those chairs and table. That's exactly how the conceptual framework is to the accounting standard. It is what they use, the raw material that they use in developing the IFRS. Another example is another similitude is if you have an architectural plan, right? If you want to build a house, you would have an architectural plan and a structural plan. So let me stick with architectural plan. If you give that to your builder, right, it brings out what it will bring out is would of course would mirror what is in that architectural design. So it's going to bring out the structure. If any other person uses that same architectural design, they will have the same structure as you. I mean, you guys will have similar structure outwardly. That's how conceptual framework is to IFRS. So you will find out, I mean, most of you should know that almost all IFRS that are dealing with similar issues, they have similar structure. As a matter of principle, all IFRS, their structure is usually definition of terms, recognition of the item, measurement of the item, then disclosure and presentation. Not only that, all standards that are dealing with assets, all standards that are dealing with assets, like PPE, for example, an intangible asset or investment property, what have you. When you look at their recognition criteria, it's very similar. When you look at their measurement basis, all of them is either they're using cost model, evaluation model, or fair value model, is similar. And that's because they have been derived from a similar basis. So they look so similar. So what will now differentiate is just what the items they are dealing with. So that's the conceptual framework here. Is it provides the basis for the development of accounting standards. So, and that's what we want to learn today. So having a basis, a singular basis for developing accounting standards is good. And that's why we are looking at some of the advantages. And the very first is that it's going to make the process of developing accounting standard to be standardized and coherent. So whenever we want to develop standards now on assets, I mean, there is a standard way. We know the idea of how we should recognize it. We know an idea of how we should measure it. And it's going to be coherent and might be easy, right? So there will not be situation where we'll just be doing patchwork basis or on imaging basis or anyhow. No. Another one is that because we have a basis, a singular basis, there won't be any form of interference, whether political majorly. So they can influence the process of developing accounting standards because we have a basis and we cannot deviate. Another one is that users and preparers will understand that accounting practice and accounting standard are based on a common ideology. So they will know we are focused on a singular foundation. They will know that we are a consistent being. I mean, it's based on a common ideology. And finally, is that it's going to provide guidance for unusual transactions, which may otherwise be open to different interpretations. So when you have transactions that there are no IFRS for, right? So you know that I told you the IFRS Interpretation Committee would usually come up with an interpretation. What gives them the guide is the conceptual framework. That is what they rely on to give them the guide on how to treat those unusual transactions. And some of the disadvantages are that because there are a variety of users, okay, that uses financial statements. So having a singular conceptual framework, providing a basis for these standards might not necessarily satisfy the need of all users. It's a disadvantage. And also, it is not clear that the conceptual framework might make the task of preparing and implementing accounting standards any easier. Okay, it might not really make it easier. So it's a disadvantage as well that we need to also consider. So what's the purpose of a conceptual framework? So the purpose will be focused on whom or who are using it. From the IASB, we will use it to develop future accounting standards and also to review existing standards. The ISB will also use it in promoting harmonization or convergence of national and international accounting standards, because that's what the ISB does. So conceptual framework will help them or assist them in doing that. And as well as the national standard setting bodies, it will help them in developing their national accounting standards. And also is the preparers or the management of entities. It can help them in applying the IFRS. Okay, it can help them in applying the IFRS. Also, it can also help the management or preparers of financial statement to develop consistent accounting policies for transactions or other events where no standard applies or standard allows a choice of accounting policies. So what this point 5 is talking about is that, you see, when we want to develop financial statements, there are always accounting policies. And accounting policies are usually developed from accounting standards. So when you have an item that there are no standard for, there is no IFRS for, so what can help you develop the accounting standard, sorry, the accounting policy for such an item would, of course, be the financials, the conceptual framework. And also, it will assist users of financial statements in interpreting the information contained in the financial statement. So it helps users to interpret. And it helps auditor in forming opinion on whether the financial statement comply with the standard. And also, it's also going to provide those that are interested in the work of the in the work of the IASB to understand how they develop accounting standard. Okay, and finally is that it's also going to assist the IFRS Interpretation Committee to develop interpretations on IFRS. Okay, so note that The conceptual framework is not an accounting standard. Like I mentioned, it only helps in developing accounting standard. And the conceptual framework doesn't override the requirement of any accounting standard. So occasionally, if an accounting standard conflicts with the conceptual framework, the accounting standard or the requirement of the accounting standard will override the requirement of the conceptual framework. Okay, so that's the first part of what we are talking about today. So since I can't really see you guys to understand your body language, who is getting it and who is not getting it. So let's look at some quizzes just to test that you're following this class. So quiz number 1. Which of the following best describes a conceptual framework? A, statement of gap. B, accounting concepts. C, accounting principles. And the last one, basis of accounting.
B.
A, that's correct. Statement of gap. The second one, when there is a conflict between an accounting standard and a conceptual framework, which one will override?
B.
Sorry, which one?
B. Accounting standard.
Okay, that's correct. The third one, the conceptual framework can help in the treatment of the unusual transaction. True or false?
True.
Okay. The fourth one, which of the following is not a purpose of the ISB conceptual framework? What's the answer? Somebody says C. To assist in determining the treatment of items not covered. No, that's wrong.
D.
Take B.
D.
To be authoritative. Yes, the answer is D. The answer is D. To be authoritative when a specific IFRS conflict with the conceptual framework. Yes, that's the answer. Okay, so that means we were following. Sorry. Okay. Now, the content of the conceptual framework. So, the conceptual framework we are looking at is the 2018 conceptual framework. That's the most recent one. It got ready in 2016. So let's go straight to what the content is. So this 2018 conceptual framework is organized into 8 chapters. The chapter 1 talks about the objective of general purpose financial reporting. The chapter 2 talks about qualitative characteristics of useful financial information. Chapter 3 talks about financial statements and the reporting entity. Chapter 4 talks about the elements of financial statements. Chapter 5 talks about recognition and derecognition. Chapter 6 talks about measurement. Chapter 7 talks about presentation and disclosure. And chapter 8 talks about concept of capital and capital maintenance. So we need to look at all of these chapters tonight. When we look at everything, then we are done. Then chapter 1, which talks about the objective of a general purpose financial report. This conceptual framework states that the objective of a financial report is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions about providing resources to the entity. So you need to know this definition. So even though the examiner will not ask you that, state the objective of a financial report, they won't ask you that, but you need to know it and appreciate it and be able to understand the items there. So look, breaking it down, the objective first states that to provide financial information. So we need to know what these financial information are about the reporting entity. We need to know what a reporting entity is that is useful to existing and potential investors, lenders, and other creditors. So we can see that these objectives is very specific about the users we are providing financial information to. Just three sets of people: investors, lenders, and other creditors, so that they can make decisions about providing resources to the entity. So let's pick it one by one. The one that fascinates my interest is the users that they said we are providing this information to. They said that is useful to existing and potential investors, lenders, and other creditors. So with this now, they have narrowed down the focus of reporting to these three sets of users. You know that there are other users of financial statement aside these three people. We have the government. Government is also a user. We have the tax authority. The tax authority is also a user. We have the international community. We have employees. I mean, and so many other ones. But here we are saying that for us, we accountants, when we are preparing financial information, it's to these three sets of people. The question is why? And the answer is because these three sets of people that provide resources to the entity. They are the ones that provide risk capital to the entity. Without these three sets of people, of businesses will have closed down. In fact, without an investor, there won't be even a business in the first place, right? Without the bank, a lot of businesses will not have been able to undertake huge projects. Without other creditors that gives trade credit, a lot of business will have run out of operation. Okay, so these three sets of people are the primary users of financial report. And I think they have asked it before at your level, asking us who are the primary users of financial report. If you tell them anything besides these three, then the guy will frown at your paper. How? Now, they said these guys will use it in making decision. So the key thing is, what decision are they making? What decision are they making? So, I mean, we can break them down. The investor will want to make a decision about whether to buy or to sell the shares of the company. That's majorly the decision the investor wants to make. So don't say that the investor wants to make the decision whether the company is profitable or not. No, that is not a decision. That one is the information you provide. On the information is there that we made a profit or we made a loss. So no, that one is information. The decision you will make from that information, you say, let me buy more of these guys' shares. Let me sell these guys' shares because they are not useful. Let me just sell and move away, right? And also, if the investor happens to be a shareholder, okay, if he happens to be a shareholder, then he will also make decision on how to vote, okay? How to vote during like AGMs, or maybe they want to take critical decision in the company. He needs to make decision around that. The lender will also make decision about whether he should provide additional loans and also whether the company can settle its loans. Those are the decisions he would be making, while the other creditors will be making decision on whether to continuously provide trade credits to the entity. So the decision they make is quite logical from the nomenclature of each of these users. Now, the final one here is the financial information. What financial information? So the financial information provided, let me look at it here, are, according to the conceptual framework, the economic resources of the entity, which is the assets, the claims against the entity, which is the liability, the changes in the entity's economic resources and claims, which is income and expenses. They have asked this before, and some people were writing statement of profit or loss, statement of financial position, statement of changes, and that's wrong. That's just the medium with which these information are presented. The financial information itself is just asset, liabilities, income, and expenses. So the way the conceptual framework put it is the way I've presented it: economic resources, claims against those resources, and changes in the entity's economic resources and claims. Okay. Finally, is that, you see, when providing this information, it's usually provided using accrual basis of accounting, not cash basis. When you provide information based on cash basis, it means that you would only put an item as asset in your books when you have paid for that asset. If you have not paid for it, even if you are using it, you will not put it in your books as that you have bought an asset. Or even if you rent a place and you have not paid for it, you will not put it in your books because you have not paid. Or even if you sell goods to someone and the person, you have not received money, you will not put it in your books because you have not received, because cash basis deals with cash inflow and outflow. But accrual basis, which is what is recommended by the conceptual framework, and if you look at all the accounting standards, is based on accrual basis, right? Because that's what the conceptual framework is talking about. So they will not conflict. So accrual basis, that recognizes economic activity, economic transaction. So we are not looking at whether you have paid or not. So when you make a sales and the person hasn't, or you have not received your money, recognize the sales as much as you have provided the service. So you just acknowledge the fact that, okay, this person is owing me. You put it there in your book that this guy is owing me. But don't say because you have not received it, so you will not record anything. Or you incur an expense. When you say incur, it means that you have enjoyed the service. You have enjoyed. That means you have incurred an expense. So even if you have not paid for that, but you have incurred it, you have enjoyed that service, put it in your books as an expense. That's accrual basis of accounting. And that's the basis with which we provide this information. And like I said, that is what all standards usually comply with. Okay, so that's chapter 1. So let's look at some quiz to be sure that you're following. So quiz 1, the conceptual framework makes it clear that financial information should be prepared using, okay, what was the answer?
Accrual accounting.
Okay, number 2, which of the following is a financial information provided by an entity according to the conceptual framework?
Claims
Yes,
against
the entity.
Number 3, which of the following is a user of financial information according to the conceptual framework?
lenders.
Lenders.
Fantastic. Chapter 2. So chapter 2 talks about qualitative characteristics of useful financial information. And these qualitative characteristics are the attributes that make the financial information useful to users. And there are 2 qualitative characteristics. We have the fundamental and we have the enhancing qualitative characteristics. The fundamental qualitative characteristics, those characteristics distinguish a useful financial information from information that is not useful. So with these characteristics, the financial information will either be useful or not useful, meaning that if the financial information has fundamental characteristics, then it is useful. If it does not have it, then that means that information is not useful, is irrelevant. Then we have the enhancing qualitative characteristics. So this would distinguish whether it is more useful from when it is less useful, which means that if the financial information has enhancing qualitative characteristics, that means that information will be more useful. But the ultimate is this fundamental. If the financial information lacks the fundamental qualitative characteristics, that is not good. That means that information is not useful. It is not useful. So they must have fundamental. It's very key. But the enhancing, well, it makes it more useful if they have it. If they don't have it, it will just be less useful. It doesn't mean it's not useful. So the fundamental qualitative characteristics, there are two of them: relevance and faithful representation. For relevance, a financial information is relevant if it is capable of making a difference in the decision made by user. Capable of making a difference. I mean, this is the ultimate. So when we say it's relevant, that means what is the decider of your info of your decision, is what you are waiting for to make your decision. Okay, but narrowing it down, making a difference in your decision means that that information must have predictive value and must also have confirmatory value. And you see, when we say predictive value, then we're talking about you must be able to use it to make predictions. And whatever prediction you make in the future, you should be able to confirm it. And from your experience, most of you seated here might have done financial reporting. You would have seen that most financial reports are historical information. So in what way would then can they have predictive value? In so many ways, Like for example, now, when you pick up any financial statement, you will see that it's usually 2 years, the current year and the comparative previous period. Is intentional because it provides like a trend. It provides a trend. So when you have performance of last year and the current year, you can have an idea of what the guy will do in the next year, okay? Because there's a trend, right? Another one is that usually where there are one-off material items, IS1 insists that you must present those one-off material items separately in the books. It's intentional too. It's just so that user will see that this item is one-off. Is wonderful. So don't think it will reoccur next year. It's just like you sold an asset, you now make huge profit on sale. You have to present such, and don't aggregate that kind of item along with your maybe admin expense, whatever, or other income. You put it profit on sale. And you in your disclosure, you will explain it very well. That is a one-off item, especially if it is material, right? Or maybe you made huge foreign exchange gain, like maybe you have some foreign currency debtors when exchange rate was like 450 naira, and they have not paid you till like when it is now over 15. Just imagine how much you collect in naira. So those are one-off gains that might not reoccur. So you need to present them separately just so that users can predict. Another one is even when you have plans to sell your assets, or you want to discontinue like a segment of your business, IFRS 5 will say, present that separately. If you have plans to sell an asset, present that asset and call it non-current asset held for sale. It's intentional. It's just so that user can predict and know that this guy wants to sell this asset though. Should I continue to associate myself with this company or not? Or maybe he wants to shut down a segment. IFRS 5 says you must separate that discontinuing operation from continuing operation. It's just so that people can make prediction. So when GSK left Nigeria earlier this year, people were shouting, they left, and all of that. The reality is that those that have been looking at their financial statements, which is out there publicly anyways, will have known that GSK was leaving because it was all there written in their financial statements. It was there. In fact, as far back as 2016, they had like 450 employees. At 2017, it was like from 450 to like less than 50. And it was there. In 2018, it was like 30. As at 2021, they were like 7. So they were doing scanty operations already. So somebody looking at financials will have seen that these people are going. And again, they were shutting down a lot of segments. Like they were the one manufacturing Ribena, they sold it. They shut down their factories. And it was all there in their financials, but nobody was looking at those. So when they left, it was a shock to a lot of people. So you accountants now, you have to be reading this financial statement, especially if you happen to want to give investment decision on what shares to buy and what shares not to buy. I mean, these financials have predictive value, and I can continue to mention examples like that of items in the financial statement that makes it have predictive value. But we'll talk about that later. We have limited time. So now, when we are talking about relevance, relevance is majorly influenced by materiality. Okay, materiality. So an item that is not really so much material will not really make so much difference in decision. And again, I'm sure you know that when we say materiality, that an item is material, it means that if you meet that item or if you misstate it, it will influence decision that user make on the basis of that financial information about that entity. That's materiality. So materiality is what determines relevance. Okay, so that's relevance, and it's a fundamental characteristics. A financial report must have that characteristics. It must have predictive value and confirmatory value. It is extremely important. So anything that is happening to your company that you know that people need to know, put it. So don't say they don't need it. It hasn't happened. No. Put it there. Let us know. Give us a lot of disclosures. That's what make it relevant. Predictive value, confirmatory value, especially if they are material. Then the next one is faithful representation. So what this is talking about is just as the name implies. So usually when we pick up a financial report, it's usually all about economic phenomena or economic transactions in words and numbers. So what we are saying that here is this, those words and numbers, which are the financial information, must represent what they purport to present. So you must present what they actually represent. So simply put, don't overstate your expenses, don't overstate your income or understate it. Don't manipulate reports. Reports or present what those items represent. So we're just trusting accountants that they will do well, that they will be honest here. So it's where a lot of manipulation comes in. So any companies that manipulate their reports means they lack faithful representation. I mean, if you are paying a rent of 7.5 million and you recognize that you are paying rent of 2 million just so that you want to reduce or increase your profitability, we are not faithfully representing. That report is irrelevant. You are just presenting numbers that is not useful to anybody. For present what they represent. So to do that, the information complete, neutral, and it must be free from error. So when we say complete, complete means all of your transactions should be included. Everything the user needs to understand the phenomena must be included. Descriptions, explanations, everything complete. Neutral. Neutral, you see, when somebody is neutral, it means that you are not biased. It means that you are factual. It means that you look at what is what, and you make decision on those facts. Neutral. So, of course, that means you would not manipulate the financials to influence decisions of users, right? So this goes a long way. This goes a long way. So you find out that a lot of companies, especially startups that want to raise money, they would always have report for investors because investors will want to see your numbers growing, especially your revenue. And some might even be interested in the traction you are generating in terms of the number of users using your product currently, and especially the daily active users. So if you one way or the other manipulate that, that means you are not neutral. That means you are not faithfully representing, and that's bad. A lot of people do this. When you do this, your financial report is not useful because it's not faithfully represented. That's neutral. So to further emphasize neutrality, they brought back prudence. So they have removed prudence from accounting before because people were misinterpreting prudence. They were seriously misinterpreting it. Some people would say that accountants are prudent, interpreting prudent as that maybe we don't spend money, maybe we manage resources. No, that's not prudency. The prudency is just saying that um, recognize revenue when you are sure that you would actually get that revenue. If you're not sure that that money will come in, don't recognize it. So when developing IFRS is based on this core guidance on prudence. So those 5-step model is just to ensure that that money will actually come in before you then go ahead and recognize revenue, as well as also it will help on determining how much you can actually recognize as revenue so that you will not be overstating your revenue. You will not. Revenue is a key issue in reporting. So the same thing applies to expenses, assets. So all prudence is saying is that when you're making judgments under conditions of uncertainty, when you're not sure about the outcome, caution. Exercise caution. Don't take the extreme position. Exercise caution. So when it comes to revenue, don't be quick in recognizing revenue because recognizing revenue goes a long way because you are creating an expectation of profits which might not exist. So be slow. When it comes to expenses, that money might come out of you. Those ones now. In fact, if there is a legal case that there could be you paying liability or paying somebody huge amount of money, even if the judge have not found you guilty, IS 37 says make provision. Make provision. And provision will eat your expense. So Prudence. It's what those standards are actually applying. So prudence is just emphasizing neutrality, just for you to be biased. Report based on facts. Report based on the transaction happening in your environment, in your business. So last one is free from error. So when we say free from error, we are saying that there should not be errors, there should not be omission when you are describing your transactions. I'm just intentionally replacing this phenomenon with transactions because that's what they mean. And also in the process by which the financial information was produced, there should not be error there. Okay, so when you consummate a transaction and you want to classify that transaction in the books, so you need to describe it properly. There should not be error. Don't go and describe, let's say, something that you're supposed to describe as an asset. Don't describe it as an expense, right? Just so to say. So description is more of classification. Classify it properly. If you don't classify properly, it could be misleading and it could be devastating. Another one is that the process of producing those information, like if you make credit sales, don't go and debit sales. That would only reduce your sales now. And credit receivables. Don't make errors like that. That's what we're talking about. So don't ever see free from error as representing that the figures in the book should be free from error or they should be accurate. So no, this is not talking about the figures. Free from error is talking about description, describe properly, and the process of producing those information should be free from error. So not the figure, because accounting, in reporting, we make use of a lot of judgments, a lot of estimates, that those figures are not in itself accurate, they are not precise. Okay, so we know that. So that's not what free from error is speaking to. Please, let's get that very clear. Okay, so these three, complete, neutral, and free from error, is what makes up faithful representation. Now, talking about free from error, saying that what we are referring to here is not our figures being accurate, because our figures cannot be accurate. So the fact that in reporting, we make a lot of estimates, we make a lot of judgments, brings me to a terminology known as measurement uncertainty. Because even though we know that you make estimates, you make judgments, if the level of those estimates and judgments becomes too high, it could affect faithful representation in such a way that your books might not be neutral anymore. So if you are making estimates, like for example, now you buy an asset, you now want to estimate the useful life. It needs to be a reasonable estimate. You have to have a basis for those estimates. Or maybe you want to calculate impairment loss. Your estimate must make sense. Or maybe you want to revalue your assets. You now need to get a revalued amount. Get a professional to do that for you. So in all of those areas where we make estimates, or maybe you want to make an allowance for receivables, do that professionally as well. So you don't just sit down and say, okay, you bought this asset. I think let's use 10 years. Let's use 5 years for depreciation. Let's use 6 years for depreciation. No, don't do that. You need to carefully look at that. Okay, what basis should we consider? Is it does the producer gives us like a lifespan? There should be, you should base your estimate on data. So that is why this thing is saying that the conceptual framework is that be careful when you are making estimate, though. Otherwise, it will affect faithful representation. In fact, IS1 particularly mentioned that when you are making estimates, you must disclose it in your books, your level of measurement uncertainty. Disclose all items where you have made estimates. Let user know so that when they are making decision on those areas, they will exercise care and caution. There is no way we can finish talking about faithful representation without talking about substance over form, which we can call in full economic substance over legal form. The whole idea around faithful representation is focused, it is breadth, it is bettered on substance over form. And when we say substance over form, from here, I gave an example. I said that transactions are accounted for in accordance with substance over form, where it is the party that is enjoying the economic benefit from an asset that recognizes it in its books and not the owner of the asset. So here, that's one example for an asset. You to report economic substance. So when you have an asset that you are enjoying, that you are using, even though you are not the owner of it, in as much as you are using that asset to make money, put it in your books. And it is on this basis that IFRS 16 came up and says that when you lease an asset as a lessee, put that asset in your books and call it right of use assets. Is economics of is just so that user can know that okay, this money you are making, we should be able to link it to an asset. And that's economic substance. Something that is making money for you is your asset. It is your anything that is making money for you, you have to put it in your books as an asset. That's economic substance. Let me move away from assets because economic substance is not all about assets. It's about reporting fully, reporting the facts, reporting the transaction itself, what is happening. So it's just like another example is that you sold goods to someone. You collected money from that person, but you did not release the goods. You are still using it. IFRS 15 says that you cannot recognize that kind of sales as revenue because you did not sell. You did not sell. When you have sold an item, you should not still be using it. So in reality, the financial reality or the economic reality is that, okay, you wanted to borrow money. In fact, that money you collected, you would in fact recognize it as loan. So instead of you to credit revenue, you credit loan. It's a loan, and you'll be charging interest on it that you are paying interest on it. That's economic substance, recognizing economic substance. And there are a lot of examples, but the point here is this: as financial reporters, we need to focus on what is happening. You need to focus on the transaction. And that's what we should report, not the legal form. We are not so much concerned about contracts in reporting, but rather we are concerned about the the substance. It's just like you are, and let me call you okay, let me say you are let's say you are into adverts, you do advert for business, right? So you help them advertise. They now give you 1 million naira that okay, help us use this 1 million to run an advert campaign. So they gave you 1 million. So you now collected 1 million. You now put that 1 million in your books as revenue. How now? How now? That's not your revenue, guy. Your revenue is just whatever margin you make. So maybe the 1 million they gave you, you go to Facebook, you do advert for them. you go to LinkedIn, you do advert for them, you go to, so whatever change that is remaining, that's your own revenue. You cannot recognize the entire goal. So you just have to be practical about these things to see what exactly is the transaction here. What is my revenue? What is my expense? What is my liability? So looking at that means you are actually applying economic substance over legal form. When you comply with that, then you are faithfully represented. Okay, so that's the fundamental characteristics. So the enhancing characteristics, that one, yeah, makes it more useful or less useful. And there are four of them. We have comparability, verifiability, we have timeliness, and we have understandability. For comparability, is very straightforward, which means that you should be able to compare, present your information in a way that we can compare it with your previous year's information. Let it be comparable. And also, we should be able to compare it with other entities' reports. You have to ensure that it's comparable. That's why IAS 8 will tell you that don't change your accounting policy anyhow, because it's accounting policy that we use to determine figures. When you change it, the figures subsequently would not be comparable with the previous year's figures. So I hesitate to say that don't change an accounting policy unless it is required by an IFRS. It's just to achieve comparability. And again, like I've mentioned, for comparability to happen, there must be consistency of accounting treatment. Okay, so the way you treat items in year one should be the same way you will treat it in subsequent years. And you must ensure you disclose your accounting policy. So these two paragraphs are actually under comparability. So another one here is verifiability, is an enhancing characteristics also. So here we are saying that your financial information should be comparable. And for it to be comparable, it means that independent and knowledgeable users or professionals must be able to recalculate your figures and get almost the same thing. For example, if you have a figure for motor vehicle in your financial information and you have 50 million, if a professional should pick up your account, you should be able to recalculate that 50 million, meaning that there should be somewhere where you will have provided, okay, this is the cost. There should be somewhere where you will have told us that, okay, this is your depreciation rates. There should be somewhere where you have told us that, okay, this is the useful life of these assets. So they should be able to recalculate it and come to almost the same figure. So verifiability is just providing sufficient information so that we can actually recheck and calculate your figures. That's what makes it verifiable. And also is timeliness. Timeliness is speaking to that your report should be provided as at when needed. You know that you have regulatory deadlines that you need to meet. Like for banks now, they need to submit their reports by the end of March to CBN. And all other companies also need to ensure they file 6 months after their year end. So by the time your information or report are not ready at those regulatory deadline periods, it becomes irrelevant. It becomes not useful, or not useful, not irrelevant, but it will become less useful. It will become less useful. So that's timeliness. And finally, here is understandability. So this is that your report should be simple and concise for users to review or understand. Okay. And when I say users here, I'm actually talking about accountants, okay, who can actually read numbers. So users here is not just anybody, because financial information, no matter how you want to make it simple, somebody who is not an accountant will not find it easy to really look at. And that's why they define the user as somebody that has reasonable business and accounting knowledge, and who is willing to diligently study the reports. You must be ready to diligently study the report. So if a user like that does not then understand your reports, then something is wrong. That means it is not understandable. So that's what understandability is actually speaking to. Okay, so that's the qualitative characteristics, and that's chapter 2. So in all of these characteristics, you must ensure and apply something we call cost constraints, which means that the costs of providing this information, okay, must not outweigh the benefits. Must not outweigh the benefits. So don't say because you want it to be relevant, you want it to be faithfully represented, you are now hiring an accounting firm that you'll be paying millions to, where this business is just you and your friend that owns it. Okay. So the people that this is beneficial to are people that actually have primary users like investors, lenders, other creditors. Those ones can try to apply all of this, because they have collected so much money that whatever costs they are incurring to get this information ready is beneficial to them. It's beneficial. It can never outweigh the benefit. Okay. Okay. Let's look at some quizzes. So quiz 1. Comparability is identified as an enhancing qualitative characteristics in the IASB's conceptual framework for financial reporting. Which of the following does not improve comparability? A, restating the financial statement of previous years when there has been a change of accounting policy. B, prohibiting changes of accounting policy unless required by an IFRS or to give more relevant and reliable information. C, disclosing discontinued operations in financial statements. D, applying an entity's current accounting policy to a transaction which an entity has not engaged in before. What is the answer here?
D.
D.
Okay, that's correct. That's correct. Number 2, faithful representation is a fundamental characteristic of useful information within the ISB conceptual framework for financial reporting. Which of the following accounting treatment correctly applies the principle of faithful representation? Which of the following correctly applies the principle? Okay. A, reporting a transaction based on its legal status rather than its substance. Excluding a subsidiary from consolidation because its activities are not compatible with those of the rest of the group. Recording the whole of the net proceeds from the issue of a loan note, which is potentially convertible to equity. Allocating part of the sales produce of a motor vehicle to interest received even though it was sold with 0%. What's the answer?
C.
No, that's wrong.
Allocating part of the sales.
Yeah, D is the answer. Allocating
D.
part of
Okay.
those proceeds to interest received, even though it was sold with zero. So this is just saying that, you see, all of these ones are actually wrong. Don't report based on legal status, like I've explained, economic substance over legal form. Don't exclude a subsidiary because it's not compatible. No, don't exclude. IFRS 10 says that you can only exclude a subsidiary when you lose control of that subsidiary. Don't record the net proceeds issue of loan that you can convert to equity. You now record it as debt. No, I mean, this thing is convertible to equity.
But if
So
it hadn't been, but if it hadn't gotten to the point where conversion to equity was due,
yes,
right?
IS
It will
32
still
says
be,
that
it will
you
be a
need,
debt until it is due,
no, no,
right?
no, no. No. IS 36 says that you need to separate it. You will recognize an element as debt and an element as equity. You will learn that in IS 32. So even though it hasn't converted, right, it's still debt. You still need to, for the fact that there is a possible conversion, that means there's an element of equity there. So you must recognize both elements, both debt element and equity element. So that's IS 32. So that's why D is the answer. And D is saying that when you sell an asset on credit, you give out the assets, the person hasn't paid you for a long time, you need to start recognizing the fact that the person is going to pay you interest. Even though it's not like you would have agreed interest with the person, but I mean, in reality, there's no free finance anywhere. So you recognize interest received, even though you did not receive it. So the third one, financial statement represent transaction in words and numbers. To be useful, financial information must represent faithfully these transactions in terms of how they are reported. Which of the following accounting treatment will be an example of faithful representation? H, charging the rental payment for an item of plant to the statement of profit or loss where the rental agreement meets the criteria for a finance lease, including a convertible loan note in equity on the basis that the holders are likely to choose the equity option on conversion, and the recognizing factor trade receivables sold without recourse, treating redeemable preference shares as part of equity in the statement of financial position. Which of the following would be an example of faithful representation?
I will pick C.
That's correct. That's
C,
correct.
yeah.
Yes, you're correct.
Thank you.
Yeah. So the recognizing factored trade receivables sold without recourse. So when you factor trade receivables, it means you are selling your trade receivables to somebody, so the person gave you money. So if the money the person gave you is without recourse, meaning that even if the person does not collect back those receivables or is unable to collect it, he cannot come and meet you and say, please give me back my money. For that reason, that means you can go ahead and recognize that receivables from your books because they are without recourse to you. Okay. All these other ones, they are not complying. They are not complying. They are wrong treatments. But you will learn them as we move on in our studies of accounting standards. Fourth one, which of the following is not a fundamental qualitative characteristics identified in a conceptual framework? Faithful representation, relevance, materiality, reliability.
Materiality.
Reliability.
That is correct. Reliability. Yeah, faithful representation, correct. Relevance, correct. Materiality is under relevance because, like I told you, it's even what determines relevance. So reliability is what is not there. Number 5, in accordance with the ISB's Conceptual Framework for Financial Reporting, which qualitative characteristics assumes that the users have a reasonable knowledge of business and accounting knowledge and willing to study information with reasonable diligence. Which of them?
Understandability. C.
That's correct. That's correct. Understandability. Fantastic. Okay, good. Means you are following. Now, chapter 3 is very short, so I'll just speak for another 5 minutes and see if you have quizzes. If you don't have, we'll go to chapter 4, which is also short. So usually in the past, chapter 2 is what I can usually ask often, which is why it's the one that took me so long. The other ones are actually very straightforward. So let's quickly address those ones in 30 minutes because I'll be closing this class in 30 minutes. So let me go to chapter 3 that talks about financial statement and the reporting entity. So this again is talking about objective and scope of a financial statement, which you already know, which is to provide financial information about asset, liabilities, income, expenses that is useful to users, and all of that. And it also talks about reporting entity. So when we talk about reporting entity, now we are talking about entities that is required to or chooses to prepare financial statements. So entities that are required to are those that are required by maybe a regulator or that needs to meet a deadline, that if they don't meet, they will be penalized, or those that just, especially those that are sole proprietorship or partnership business. Okay. So again, a reporting entity can also be a single entity, it can be a portion of a single entity, and it can be more than one entity. And a reporting entity is not necessarily a legal entity. So summarily, we can say a reporting entity is any form of business entity. Any form of business entity can apply IFRS, right? So it could either be a sole proprietorship business, a partnership business, a company. So don't think a reporting entity is a company. No. Like is mentioned, the reporting entity is not necessarily a legal entity. Then reporting period, I mean, that's the period that's covered by your financial information, right? But it's not necessarily the current period alone. It also can be the comparative period where you provide comparative information. And with those two, then we'll be able to have some forward-looking information, okay? Forward-looking on the basis of those comparative and current, we could have some predictive value. So, but reporting period is current and reporting and previous period. Then perspective adopted in financial statement and going concern assumption. So talking about the perspective, this is saying that your information should be prepared from the perspective of the reporting entity as a whole and not that of investors. This is emphasizing that the financial information you are presenting is about the reporting entity, nothing else. Don't be biased. The perspective is the reporting entity, and that's all. That's all we want to, the investors want to see. So don't say because you want your investors to see profits, you are now manipulating. No, that's not allowed. And when you are preparing those financial information, you must prepare it on the assumption that the entity is a going concern, that the entity will continue to operate into the foreseeable future, that they will continue. And when you check items like the way we treat depreciation, for example, now, depreciation is on the assumption that this company will continue to operate. That is why we can say, okay, we want to depreciate for over 5 years. Is you're assuming that they will continue to operate. Items like allowance for doubtful debts is assuming, is saying that this company will continue to operate. That's why we are estimating that some of our receivables might not pay. And a lot of other items like that. is prepared on the assumption that the entity will continue to operate as a going concern. And finally, is consolidated and unconsolidated financial statement. So whenever an entity has subsidiaries, consolidated is better than unconsolidated. And that's chapter 3. Now, chapter 4, this talks about the element of financial statements, talking about assets, liabilities, equity, income, and expenses. So an asset is a present economic resource controlled by the entity as a result of past events. And an economic resource is a right that has the potential to produce economic benefits. So when we talk about an asset, it has to be present, which means that you must have actually acquired the asset. It must be present. And it is an economic resource. So in this second sentence, they said an economic resource is a right that has the potential to produce economic benefits, which means that anything, of course, rights, that produces money for you. When you say produce economic benefits, it's majorly money, cash flow, or maybe savings, or maybe reduces your liability. But I mean, the way you can easily get it is whatever makes money for you, as bringing in money for you, is an asset, is an economic resource. That's what this thing is saying. And this economic resource doesn't necessarily have to be a tangible item, something you see. Don't see economic resource as a house, a building, a plant. Economic resource can be an investment. Maybe you invest in shares. Economic resource can be a software. Economic resource can be a mineral rights. Economic resource can be a license. Anything that brings in money to you is an economic resource, right? So a present economic resource, yes, but this resource, you must control it. So when we say bring in money, that money must come to you. That's a control there. If the money that economic resource is making, if it's not coming to you, it's not your asset though. So that why economic substance over form can conveniently say that when you are using an asset, even though it's not your own, put it in your books. It's because the fact that that asset you are using it and the money you are making is coming to you, you have control. It's your asset. Put it there as your asset because you have control. Control here means that whatever money that is made is coming to you. That's the control here. Okay. So of course, as a result of past events, you have purchased it in the past. So that's an asset. Then a liability is a present obligation of the entity to transfer economic resource as a result of past events. So again, a liability must be present and it must be an obligation. Present in the sense that it exists already. And an obligation is like a duty that you must act in a certain manner and you have no practical ability to avoid it. That one is very important. You have no practical ability to avoid. Something you must do and you cannot avoid it. That one is obligation. Then you can be talking about you having a liability. If you can avoid it, that one is not an obligation. No. You have no, that's how the conceptual framework puts it, is your responsibility to act in a certain manner and you have no practical ability to avoid it. That's an obligation. So, and what is it that you cannot avoid? To transfer economic resource. So we can simply say that anything that requires you to pay money is a liability. And you cannot avoid it. You cannot say no, that you must do it. Because if you say no, they can jail you or something bad will just happen. Then you have an obligation, oh, and you have a liability. Yeah. Next one is equity. So equity is the residual interest in the assets of an entity after deducting its liabilities. Okay. So residual interest is the key item here. So yeah, so when we talk about interest in the assets, so the of course the person that has interest in assets in an asset of an entity primarily will be the shareholders. They are the one that has interest in the asset. And also, if the company has creditors or liabilities, those also have interest in the assets. So when we say interest, it means that whatever money that asset is making, those are the people that actually get those money. So those are the people that have interest. So when your interest is now residual, then you are an equity. Residual in the sense that when that money comes, you are the one that usually gets settled last. That's residual. And you're an equity. So a typical example of equity is ordinary shareholders. Ordinary shareholders as pay dividend last, they are considered last in all ramifications. So that's equity. It's no more than that in reporting. Residual interest in assets, of course, after deducting all liabilities. Then income. So when the money you are generating from your asset is income, okay? So that's why income is increase in assets. So that increment in your assets is an income. It could also be a decrease in liabilities. That's also an income. So if you are owing 30 naira and the person says, okay, don't worry, just pay me only 10 naira, there is a decrease in your liability of 20 naira. It's an income. So for whatever reason, if your liability decreases without necessarily paying, it's an income. So when government gives tax incentives or tax cuts, they are income for you. Now, this increase in assets, decrease in liabilities that results in increase in equity. So increase in equity is also would be an income, but you see, this increase in equity we are talking about here is other than those relating to contributions from holders of equity claim. So contributions from holders of equity claim is capital, additional capital. So increase in equity resulting from additional capital is not income, because additional capital is also an increase in equity. So that one is not income. So the increase in equity here is profits or gains. Those ones also increase your equity. And and their income, yeah, their income. And finally, here is expenses. So expenses is like the reverse of income, decrease in assets, increase in liabilities that result in decrease in equity, other than those relating to distributions to holders of equity claims. So when your asset decreases is an expense, when your liability increases is an expense, it will result in a decrease in equity. But this decrease in equity here is other than those relating to distributions to holders of equity claim. Distributions to holders of equity claim is dividend. Dividend is not an expense. Dividend is a share of profit. That is why you will not find dividend in the statement of profit or loss. You would only find it in the statement of changes in equity. So this decrease in equity here is not dividend, but the decrease in equity we are referring to here is losses. That's the expense here. Okay, so all this explanation I've given that I've been talking about actually detailed out in these notes. So when you get these notes and you're revising, you will see everything there. So let's look at some quizzes, so just to be sure that you're not sleeping. Number one, in accordance with IESB's conceptual framework, what is the definition of income? Okay, so that would be increase in assets, whatever. So the answer is between C and D. So what's the answer?
C.
C.
That's correct. That's correct. Number two, Winner PLC has purchased the patent for 20,000. The patent gives the company sole use of a particular manufacturing process, which is saved 3,000 for the next 5 years. What element of financial statement is this patent?
Then assets.
Assets. So use is control.
Exactly. That's correct. You're correct. So number three, Ade Limited paid Wisebaba PLC 10,000 naira. Paid him 10,000 naira to set up a car repair shop on condition that priority treatment is given to cars from the company. What element of financial statement is this 10,000 naira to Ade Limited?
It's a liability.
Liability?
I'll say is it it's an expense.
That's correct. That's correct. I mean, how do you know it's an expense? Tell me.
They are actually paying for a particular service, even if they are asking for priority treatment, they are actually paying for a service.
Yeah, you're correct. You're correct. So he's not asset because he doesn't have control. He's not an equity because it's not like he has interest in the assets. Of course, it's not an income. Of course, it's not a liability. It's not owing anybody. So expense, you're very correct. So that's smart. The next one, Truthful Limited provides a warranty with every car sold. What element of financial statement is the warranty? What's the answer?
The liability.
That's correct. Liability.
The liability.
Yeah. Okay, fantastic. So that's chapter 4. You see that we have been a bit faster now. Now, chapter 5 is also another short one. So this one is talking about recognition and derecognition. So recognition is just a touch way of saying recording. Yeah, and it's like the process of capturing for inclusion in the statement of financial position and statement of profit or loss, an item that meets the definition of one of the elements of financial statements. Okay, so that's recognition. So the core thing here is the criteria for recognition. So that's what this one is saying, that an asset or liability should be recognized if it will both be relevant and provide users of financial statements with a faithful representation of the transaction of that entity. So this one is talking about fundamental characteristics, relevance, and faithful representation. That means that the recognition criteria for any item to enter the financial statements, there are two from these two paragraphs we just read. Number one is that item must meet any of the definition of one of the elements of financial statements. Before you can enter an item, you must meet any of the definition. Number two is that that item must meet the fundamental qualitative characteristics of relevance and faithful representation. And that's what that is talking about. Then secondly is derecognition, which is the removal of all or part of a recognized asset or liabilities from an entity statement of financial position. So the recognition normally occurs when the item no longer meets the definition of an asset or liability. So that's the recognition, but they can ask you the criteria for the recognition. You can see when there is loss of control or where the entity no longer has an obligation for a liability. So you would see that this too is an explicit way of saying that the asset or liability no longer meets the definition of an asset or liability, because as soon as you have lost control, you don't have the asset anymore. Or maybe you don't have an obligation anymore, because those are the key items in the definition of an asset and liability. And you see that the recognition really focuses on asset and liability alone, because as soon as you derecognize assets, they can be income now. Or as soon as you derecognize liability, they can be expense, because those are what create income and expenses. And usually, is your asset minus your liability that gives rise to equity. Equity is just a residual interest in the asset after deducting liability. So that's why this guy focuses on asset and liabilities. And that's what they were asking in the exam. And that's chapter 5. Chapter 6 talks about measurements. So elements recognized in the financial statement are quantified in monetary terms. So you need to get an amount for them, and that's what we call measurement. So usually it will require selection of measurement basis. So what we want to learn here is measurement basis, and we're going to learn two measurement bases. One is historical cost, two is current value. So historical cost is the price paid for an asset or for the event which gave rise to a liability. Historical cost does not change. The price will not change in such a way that if the measurement basis you are adopted is historical cost, if you buy an asset in 2015 and we are in 2024 now, it's the amount you bought it in 2015 that you will still be recording in your books as cost of the asset in 2024. Imagine buying a Corolla in 2010 for 1.2 million Tokumbo. And if you want to buy Nigerian use as of today now, if you don't have almost 3 million, just go and park somewhere. It's not possible. And in your books, as of today, you would not change the price if you are using historical costs. The cost will still remain how much you bought it as at that time. So that's historical cost, and is a measurement basis with which we use even till date. The alternative one is current value. This also takes cognizance of the price you paid for an asset or liabilities. Just that this one is usually updated. They update it to reflect any changes since it was acquired or incurred. That's what differentiates current value from historical cost. So current value, it's usually updated with what is happening right now, with changes in the economic environment. Historical cost doesn't change, current value do change. So there are three bases recognized by the conceptual framework that makes up current value. So when we say current value, is either fair value, value in use, or current costs. And for fair value is usually determined where you want to sell an asset, when you want to exit an asset. So it's usually based on the price that would be received to sell an asset. That if I want to sell this asset, how much will I receive? So you want to exit, you want to sell, or that will be paid to transfer a liability in an orderly transaction between market participants at the measurement date. So, for example, now, if you want to get the revalued amount for a building, right? You want to get the fair value. So the basis, if you're using fair value, it will be okay. If I want to sell this asset today, how much will I collect? That's the fair value. And it's popularly used right now. Most standards they are moving towards fair value, which we are going to learn pretty soon. Even from next week, when we start learning share-based payments, you will see a lot of fair value there. Another one is value in use. The only instance where I will mention value in use is in IS 36. Can't remember me going to mention it in any other topic except IS 36. And it's usually used when you want to determine the value you will get from continue to use an asset. So if I continue to use this asset for the next 10 years, what's the value to me today? That's value in use. And the way that is obtainable is by getting how much benefit you will get for those 10 years, then discounting them to present value. Then that's my value in use. Finally, is current cost. So current cost is similar to a historical cost, right? Meaning that it looks at entry value. Okay, if I want to buy this asset, how much? Okay, just that you have already bought it, but the current costs now is looking at, okay, if I want to buy it, a similar asset today, how much is it? It's just so that you'll be updating what you have in your books. So current cost will reflect prices in the market, which the entity would acquire the asset or incur the liability. So it's like a replacement cost. Current cost is like a replacement cost. So summarily, two measurement bases, historical cost, current value. So when we talk about current value, it's either fair value, value in use, or current cost. So it's either of those three. Okay, all of those explanations are here for you. Again, let's look at these two quizzes. Quiz. In accordance with the IASB's conceptual framework for financial reporting, which of the following is not a measurement basis of financial statements?
Present value.
B.
That's correct. Two, which of the following criticism does not apply to historical costs? Financial statement during a period of rising prices. They are difficult to verify, they contain mixed values, they understate assets, they overstate gearing.
They understate assets.
That one apply now. Yes, historical cost actually understate asset now. Like the example of Corolla I gave you, that you bought for 1.2 million in 2010, and you are still carrying it in your books at 1.2 million, when it is now worth almost 5 million. So yes, it applies. They actually understate assets and they overstate your profits because you'll be recognizing small depreciation.
A.
B, they contain mixed value.
A. They are
Yes.
difficult to verify.
A.
I see.
The only one I've not had is D.
B.
B, they contain mixed values. Some items are current, some items are out of date value. Yes, that one applies to historical cost too, because it depends on when you bought it. So the ones you bought long time ago, you will still be carrying it at that price of long time ago. So outdated, right? The ones you bought now, so historical costs will now be the current value. So they actually contain mixed value. So that's not the answer.
D.
And yet, it's not
D.
D.
A.
Ah.
Which are difficult to verify.
Yes, A is the answer actually.
Wow.
A is the answer. So they are not difficult to verify you. They are not actually. So when you say they are difficult to verify because transaction, this one does not apply. Historical costs, it doesn't change. So what's out there to verify? It doesn't change. You know so you can easily check. So this one does not apply. This one applies to historical costs because they actually overstate gearing. Because of the fact that they depresses your assets, then it makes your liability look so high. And when your liability is much more than your assets, that's what we call gearing. It means it makes you overgeared. So the answer is the only one that does not apply to historical costs is the fact that you are saying historical costs is difficult to verify. How now? It's not. It's
Yeah,
not difficult to verify.
yeah, you're right. Yeah.
So chapter 7 is presentation and disclosure. So this one is quite straightforward. All of these elements, you need to present them in certain statements. You need to make certain disclosures. So they started with principles of presentation and disclosure, saying that you must ensure that you classify your assets and liabilities in a way that you group similar items together, and any item that is material, you present them separately, and also avoid unnecessary details and avoid standardized approach. Don't have like, okay, this is the template. No, present your income, your assets based on your business, based on the nature of your business. So when you're presenting, you present your income and expenses in the statement of profit or loss. And if there are other gains that you made, not from your primary activities, but rather they are from changes in value of an asset or liability, those kind of gains, income or expenses, they should be in the other comprehensive income. So any gain arising from changes in current value. So like if you revalue your assets, your non-current assets, and you're having a gain, that's a change in value. So you put it in other comprehensive income. So when I revise IAS 16, I will talk about that. When we talk about IAS 19, we will talk about return on plan assets and also actuarial gains or losses. These are gains that are arising from changes in value. So they go to OCI. When we talk about measurements of financial asset at fair value through OCI, this is talking about when you fair value an asset, and those assets, you have made your decision that it should be through OCI, then those goes to OCI as well. However, there's an opportunity for recycling in the sense that when those changes in value, the reason they go to OCI in the first place is the fact that they are unrealized. They are not something you want to put in your P&L and be telling your shareholders that you have made so much profit and you are promising them dividend from there. So we don't want that to happen. And that's why they take it to OCI. So when those changes in value becomes realized, when it becomes realized, you could recycle them and transfer them to POL. Okay, that's what recycling is actually speaking to here. Okay, I'm going to stop here tonight so that I would start from chapter 8, which is the last chapter here, because I would try and review some of this. before I start IFRS 2 next week. Next week, Wednesday, we'll do IFRS 2, share-based payments, and see where that takes us. Okay, so guys,
You will send this to you. Will you send this to us, please?
definitely. And please read it immediately. Don't delay reading. Start reading all of these things. And mistake a lot of students make is this. You see, these things all of these items we are talking about is actually the foundation of. We actually taught this topic in skills that is in your syllabus again. They say we should teach you again. It's like the foundation of a lot of students will just ignore and not read it. They will go and sit down on group account and all of that. Last day, they surprised you guys. They didn't even, question one was not consolidation. In fact, it was just preparation of a single entity's account. And funny enough, students were dazzled. When I looked at the question, I mean, the guy teaching consolidation was a bit disappointed because we have trained you on consolidation for months, but they did not ask it. But the question is okay. It's okay. It's just normal adjustments and preparing accounts. But
There was
because
no
a lot of
consolidation at
students
all in the entire paper.
at all, at all,
Nothing at all. The whole 7 questions.
the whole 7 question, there was no consolidation at all.
Wow.
So you need to really understand these things very well. So students that have good background, have actually read all of these things, would have done well and be able to get 50 and move on. And that's how we train you at Equity Professionals. We go to the basis. We don't omit anything. We don't over concentrate on a particular topic and promise you that this is one that will come out though. No, we won't do that. So one thing we are sure is that we will finish the syllabus. We would teach. There is no way you enter the exam and you will not see everything we have taught you there. It will be there. So it's just left for you to. Yeah, so besides students omitting and not reading all of these major core principle is we find out that students will leave our note and they will now go and buy one big textbook and be reading that one. For heaven's sake, why would you do that? Have you even finished reading this? A smart student would read these notes that I'm showing you over and over again and will get used to this one because this has everything you need along with your past questions. There is no way you won't pass because by the time you are used to this one, I mean, there's a level of confidence it gives you that, okay, I've read everything. Rather than jumping from one textbook to the other, that you will not finish. So if you have that textbook and you can finish that one too, dust it. You see, what I don't like when preparing for ICANN exams is creating uncertainty for yourself, having too many materials. It dampens your confidence that, I've not read that one, I've not read this one. But by the time that's why you're in class anyways. That's why you have us. So we have put a lot of efforts in putting these unique materials together for you, for your exam. So speaking for corporate reporting, with this one that I could have decided to collate this. I have all the solution, I have everything here, and start selling it as textbook. I'm not interested in doing that. I want to give you this. So your responsibility is just to ensure that you read this. And if you have so much time at your disposal, yeah, of course, you can consult other materials, but at least read this one first, like 4 times. Then you can at least I'm satisfied because all the materials I'm sharing with you, there is no way you will read all of them along with what my colleague is going to share with you that you will not pass that exam. It's impossible. It's impossible. Okay, let's leave those stories for another day. We still have a long time together, 16 weeks. So, I mean, the journey has started. I have like 12 participants in this class, and on my group in CR, I have well over 30 students. Okay, so over time we'll see. If they don't join, that means we need to remove some of those students that are not really students from that group, so that we'll know who are actually students, so that that group that we have would be useful to everybody. Because I want that group to be active. Don't just, it's not group for grouping sake. You need to be, I mean, when you are reading, there's a way you can include your colleagues by sharing some tips, what you have learned, by sharing some questions. You guys find a way to communicate, find a way to link up. Don't let distance be a restriction for us. So let's know one another, let's interact, and let's make this 17 weeks, not 17 weeks anymore, 16 weeks we have left together. Let's make it useful. You know that in addition to that 16 weeks, you still have an extra 2 weeks before your exam. So practically, you guys have 18 weeks left to your exam. So let's keep it active. Let's keep our mind active and get ready for the ultimate task in November. So for now, I will end the class. Then we'll continue next week, Wednesday. Thank you very much. Have a wonderful night.
Thank you.